beware of people that give you a lot of numbers about their businesses. I mean, in terms of projections or valuations or that sort of thing. We try to give you all of the numbers that we would use ourselves in making our own calculations of value. We really, if you read the Berkshire reports, you essentially, you have all the information that Charlie and I would use in making a decision about the security. If there's anything really lacking in that respect, you know, we would truly appreciate hearing from you, because we want to have that kind of information in the report. But then we want you to make the calculation. But we've stuck, I mean, that material, for example, on the float in the insurance business, we consider that quite relevant, obviously, because we use up almost a page printing it. It's pretty serious stuff at Berkshire. But that is relevant. I mean, your interpretation may be different than mine or Charlie's, but those are important numbers. And we could give you a lot of baloney about satisfied policyholders, you know, in Lincoln, Nebraska. Wouldn't tell you a thing about what the company's worth, and have pictures of them and happy, you know, receiving the check from the agent, all of that. But we're not going to do that. It
reminds me of a famous headmaster who used to address the graduating class every year, and he'd say, you know, he says, 5% of you people are going to end up criminals. And he says, I know exactly who you are. And he said, but I'm not going to tell you. Companies that constantly told their shareholders what the intrinsic value was were the real estate holding companies in corporate form. And I must say that the amount of folly and misbehavior that crept into that process was disgusting. We would be associating with a bad group if we were to change our ways.
Bill Zeckendorf Sr., I think, was probably the first one to do that with Webb and Knapp back in the late 50s. I still have those annual reports, and he would announce, you know, like to 8 decimal places what the intrinsic value of Webb and Knapp was, and he did it right till the day they filed for Chapter 11.
I remember that well, because somebody said that he fell into bankruptcy, and somebody else said, how could you fall off a pancake?
I wondered if you feel that the speed with which information is available and disseminated today has affected your business buying decision process. And do you believe that speed has caused you to miss opportunities?
Question about C's expanding?
No. Does the speed of information today affect our decision-making process?
No, I would say that we perform about like we were doing 30 or 40 years ago. I mean, we read annual reports. The speed of information really doesn't make any difference to us. It's the processing and finally coming to some judgment that actually has some utility. That is, that it's a judgment about the price of a business or a part of a business, a security, versus what it's essentially worth, and none of that involves anything to do really with quick information. It involves getting good information, but usually it's not. We're not looking for needles in haystacks or anything of the sort. You know, we like haystacks, not needles, basically, and we want it to shout at us. And I would say that. Well, virtually everything we've done has been reading public reports and then maybe asking questions around to ascertain trade positions or product strengths or something of that sort. But we never have to. We can make decisions very fast. I mean, we get called on a business or we can make up our mind whether we're interested in 2 or 3 minutes. I mean, that takes no time. We may have to do a little checking on a few things subsequently, but we don't need to get. I can't think of anything where we really need lots of price data or things like that extremely fast to make any decisions. We've got good management information systems in our operating businesses, but that's That's just another, that's a question of keeping inventories where they should be and all of that sort of thing. I don't think I think you could be in some place where the mails were delayed 3 weeks and the quotations were delayed 3 weeks, and I think you could do just fine in investing. I think the question is, do we get into asset allocation by maintaining given levels of cash depending on some kind of outlook or something of the sort? We don't really think that way at all. If we have cash, it's because we haven't found anything intelligent to do with it that day in the way of buying into the kind of businesses we like. And when we can't find anything for a while, the cash piles up. But that's not through choice. That's because we're failing at what we essentially are trying to do, which is to find things to buy. And we make no attempt to guess whether cash is going to be worth more 3 months from now or 6 months from now or a year from now. So it is. You will never see. We don't have any meetings of any kind anyway at Berkshire, but we would never have an asset allocation meeting. We would keep looking. I mean, Charlie's looking, I'm looking, some of our managers are looking. We're looking for things to buy that meet our tests. And if we showed no cash for short-term securities at year-end, we would love it, because it would mean that we'd found ways to employ the money in ways that we like. I think I would have to admit that if we have a lot of money around, we are a little dumber than usual. I mean, it tends to make you careless. And I would say that the best purchases are usually made when you have to sell something to raise the money to get them, because it just raises the bar a little bit that you jump over in the mental decisions. But we have, I don't know what we'll show, but certainly well over $1 billion of cash around, and that's not through choice. That is that you can look at that as an index of failure on the part of your management. And we will be happy when we can buy businesses or small pieces of businesses that use up that money. Basically, when you lay out money or accept insurance risks, you really have to think for yourself. You cannot let the market think for you. Charlie?
Yeah, I think Berkshire is basically a very old-fashioned kind of a place, and it tries to exert discipline to stay old-fashioned. And I don't mean old-fashioned stupid. I mean, the eternal verities, so to speak. Basic mathematics, basic horse sense, basic fear, basic discriminations regarding human nature, all very old-fashioned. And if you just do that with a certain amount of discipline, I think it's likely to work out quite well.
I have really enjoyed reading your annual letters and your annual report, and I've gone back and read all the older ones too. They're terrific. I have also enjoyed reading the 2 books by Peter Lynch. And I see a lot of commonalities between the two of you, the way you think and your philosophy, etc. I'd certainly appreciate it if you'd make a few comments on what you think of Peter Lynch, the things he says in his 2 books, and the advice that he gives to investors. Thank you.
I know Peter. I don't know him well, but we played bridge together in Omaha, as a matter of fact. And I like him personally, and obviously he has an outstanding record. And he has written those 2 books which have been bestsellers about his investment philosophy. I don't really have anything. I'm not going to embroider on his. There's certainly a fair amount of overlap. There's some difference. Peter obviously likes to diversify a lot more than I do. I mean, he owns more stocks than the names of companies I can remember. I mean, but that's Peter. And I've said in investing in the past that there's more than one way to get to heaven, and that there isn't a true religion in this, but there's some very useful religions. And Peter's got one, and I think we've got one that's useful too. And there is a lot of overlap. But I would not do as well if I tried to do it the way Peter does it, and he probably wouldn't do as well if he tried to do it exactly the way I do it. I like him personally very much. He's a high-grade guy.